Hello, everyone, and welcome to today's webinar, Mastering High Volume Transactions for Accounting and Compliance, sponsored by GBQ Partners, LLC, and Hubifi. Now I'd like to turn it over to Jason to start today's webinar.
I realized I was just muted for all of that, so sorry. Welcome, everybody. Already a technical difficulty on my part. Well, sorry about the delay, but yeah, I'm joined today by Ed and Jeff with GBQ, and I'll be helping to both moderate and host the event today to talk about high volume scenarios. My background is around accounting automation, came from a corporate accounting background as well as a fractional CFO practice. Since then, I lead Hubifi, which specializes in high volume revenue accounting automation. But Jeff and Ed, why don't you introduce yourselves and tell us about your backgrounds?
Thanks, Jason. Ed Bannen, partner here in the assurance practice at GBQ. Have 10, 15 plus years experience with various clients in the high volume transactions, whether that be tech, manufacturing, software, construction, um, financial services. So, very, very hot topic with what's going on in the space, and excited to talk to you all today.
And I'm Jeff Monsman, a partner in GBQ State Level Tax Department. Focus my practice on indirect taxes, so sales and use, which will be a real hot topic, and probably the majority of what I speak about today, especially when we talk about high volume transactions. It's usually got a lot of sales and use tax implications, but I also do lead our indirect or our personal property and unclaimed property practices as well. And know enough to be dangerous on the income franchise side as well. So we'll try to layer in some of those items as we go through today's presentation too.
Great. So high level agenda today, we're going to start with a little bit of a refresher on ASC 606, the 5 steps Ed's going to walk us through, specifically how you should think about that from an accounting and policy perspective to be consistent with GAAP. We're then going to get into a little bit more, detailed use cases and problems folks run into, actually implementing some of these concepts and policies with ASC 606. Then we're going to pivot to talk about CECL and really around like credit loss, bad debt, a lot of process-oriented things about how to actually implement CECL, not only actualizing the bad debt into risk profiles, but then also how to create estimates when you're booking that revenue and basically anticipating and forecasting who's not going to pay and who is going to pay and what some of those best practices are. From there, we're going to pivot and spend some time talking both about the operational tool stack as well as the accounting tool stack and things that folks need to take into consideration, whether their high volume is a centralized business model or decentralized, and what they need to scale. And then last but not least, we're going to have a discussion around data management best practices, what you need to think about from an audit perspective, how to make sure you're audit proof from a provenance and lineage perspective, and really tracking your financials and what transactions they're based on and the calculations that you took to get to those end results are really key parts of that. So let's go to the next slide. Perfect. And so some of those scenarios that I alluded to, particularly with ASC 606, some of the most common ones we see with high volume is that it's not just a single transaction at a point in time. It's a lot of times many transactions and entitlements on a contract with a customer that have revenue being recognized over time. Some of that's going to be milestone based. Some of that's going to be pro rata. Some of that's going to be immediate type of rev rec. And then when you factor in things like there's always backdated adjustments, like contracts are almost never just a plain Jane contract and then that executes and then completes pro rata nice and clean. A lot of times just backdated adjustments, but obviously you're not going to backdate anything into a previous accounting period. And so we want to talk about best practices for adjustments, lots of different systems and sales channels that we need to account for, and then particularly around deferred revenue and how to think about deferred revenue for like subscription or revenue over time scenarios are, I think, key things that we want to dive into. Otherwise, the CECL and some of the expected credit loss calculations, this ends up being directly related to revenue in many ways, because for these high volume businesses, you have these customer contracts and you've earned the revenue, but whether or not you're going to get paid and that probability of whether or not you're going to get paid is really at the core of CECL and the implementation. Other than that, automation and scalability. This one is really around trust is the big part of scalability. Is how do I know my numbers are right, and how can I recreate my numbers and prove to an auditor, a third party, et cetera, that we could recreate those numbers. And then you want to do that in a non-manual way, because manual is both obviously inefficient, but it also introduces incremental risk from a controls perspective, inherently just process risk. Last but not least, we talked a little bit about decentralized versus centralized models. Either way, high volume businesses a lot of times are knocking on the door of Excel or some of these traditional manual process tool limitations. And so what are some of the best practices to be able to move around Excel or out of Excel if you're in a high volume business and you're kind of pushing the limits of some of those existing tool stacks? Let's go to the next slide. Perfect. And so we're going to ask a quick question here, and this is going to be related to CPE. So we're going to give you guys a minute to take a look. You should see a pop-up on your screen to be able to answer those questions. Once you cast your vote, then we'll get right back to the presentation.
Good mix of issues here, Jason.
Yes, there is. Perfect. And for those listening in, just to help, the question is, which high volume accounting scenario are you most concerned for organization? The options are ensuring ASC 606 compliance, automated expected credit loss calculations, streamlining transaction processes, or leveraging data to make timely decisions. Perfect. Well, let's pivot, and Ed, would love to kind of get a refresher back to our basics around the 5 steps, the concepts we think about for ASC 606, and give folks a little bit of a refresher on those old rules.
Yeah. So coming back to the model, so identifying a contract, step 1. And, for a lot of different businesses, that seems easy. If there's a written contract, it's really easy. If you're a retail individual, that contract is really the price and that transaction done in the moment you swipe that credit card. So it can be promotional in nature. There can be unwritten contracts. It can be verbal. It can be basically agreed upon in the situation. So identifying those contracts is step 1. And then within those contracts, it can be more complicated. Should you be bundling them? Should there be standalone? Once we get into that, kind of starts to creep into that step 2. So these arrows, there's not hard deadline or hard cutoff points, but as we really move to identifying those performance obligations, for example, if you're in an insurance contract, you have a signed contract, what do you need to deliver in order to recognize that money? As Jason alluded to earlier, we have differences in timing between when the cash is received and when the revenue is recognized. And to Jason's point, with a lot of these businesses and high volume, this is really nuanced and granular. And if you only have 10 contracts, this is not difficult. But if you're dealing with thousands of transactions, you really need to ensure that you're able to streamline this process and identify those multiple performance obligations. So a performance obligation can be anything from delivering a good to providing a service contract. Hey, if I send you an engine and I also sold you that I would give you maintenance on that, there's potentially separate performance obligations that you would recognize differently despite having a single price. Similarly, we go through those with again, retail. If I gave you points and rewards programs, that actually turns into a separate performance obligation, in which case some of that money gets held back. So it can get a little nuancy. The next step is step 3, determining the transaction price. Now, the transaction price, this is where, depending on when the cash is exchanged, it isn't just the amount you exchange day 1, and it can be more. And this is where you might be bundling, and there's different items that you have to come up with. What is the actual transaction price? Now, the transaction price by definition is meant to be the list price. So when you buy something at a discount, you're buying, that discount might need to be applied to multiple performance obligations, but you're going to use that initial transaction price to determine, how much of that bundle should be allocated and whatnot. So transaction price in this scenario, think as list price, what you would sell it to anybody for at any price without any discounts. And then step 4 is allocating that transaction price to the performance obligation. So this is where it kind of comes into, okay, if I did have a discount, how much should I apply to each? Again, this is where it kind of gets nuancy. We might write the contract with, hey, I'm going to give you all these services for free. All you got to do is pay for this license. And the reality is the economics of that isn't how GAAP wants you to record it. So naturally, they had to make the codification a little more complex so that you have to go and apply out that economic value. So this is where, again, having a system that can streamline the allocation of these pieces, because they can be very complex, and finding a repeatable process is extremely important for companies like yourselves that have multiple high number of transactions, where you're not going to be able to come in and evaluate each of these on an individual basis. And then last, step 5, the big key point here is point in time versus overtime. When should you recognize the revenue? How much of it should you hold back? And at what point can you recognize any of that revenue you hold back? So determining, this point is very determinant on, when is control passed? Do you have any further obligations? The nature in which you're delivering that service. Is it being spread throughout a period? Is it being, hey, as soon as I turn on this switch, you have full access to my database. I have no further obligations. That could be point in time. This can be one of those decisions where it's important as you work to map out your process, you then can streamline it. So a little bit of an overview. I know I went through that quickly. There's a lot more detail if you really want to dive in, but just a quick overview for the team.
Well, Ed, the funny thing is when you think about the 5 steps, super simple 5 steps, the complexity comes in when you start to intermingle these things, and the implementation becomes challenging. So, for example, if you have a contract for a customer that has multiple performance obligations and a discount, well, all of a sudden you may have an immediate performance obligation and then a performance obligation over time. That discount may need to be spread. One is pro rata for the discount being earned over time. The other one just gets applied as a percentage of that list price allocation for number 4. And so the complexity implementation really comes from, like you said, not a single contract that all the dates and everything magically lines up. It's really when there's combinations of allocating transaction price plus obligations, even systems in a lot of cases, like you mentioned, the warranty. I've seen plenty of cases where customers have an order entry system where the original engine you mentioned came from, and there's a part of a contract there. There's also the warranty or maintenance operating system. And so while the contract with our customer is a single document, that data may live in 2 systems for the same contract, or you may have hundreds of thousands of the same contracts with variability. And all of those things are the challenges I think that the corporate accounting folks come and have to deal with from an implementation perspective.
Absolutely. And I think the hard thing too is going to be the cash versus non-cash, right? Most people want to follow the cash when you're in high volume because that's the easiest thing to reconcile. And rarely is that the true indication of revenue, expense, obligation, right? So we've definitely made the environment more complex, but I think that hopefully these software tools are helping us get back on track to the nature of the standard is to recognize value when delivered and created versus just cash received.
Yeah, not to throw additional complexity on top of it, but from the tax side, right? You've got a completely different set of rules, So you go through this from a revenue recognition standpoint, and those might not be the rules that the states play by from a sales tax standpoint, right? Especially when we start talking about leases and installment payments and deposits and stuff. A lot of times, the general rule on sales taxes, we're talking about a cash basis, right? So when people are operating on an accrual basis, and then they're supposed to do their sales tax on a cash basis, you could be doing things where you're fronting sales tax, remitting it. I know we'll talk about bad debt in a little bit, but you start running into these things where your tax obligation is in conflict with what your accounting obligations are. And honestly, too, that's a lot of times where that first breakdown comes in of things not harmonizing. So then, you get a state tax auditor that comes in and they're like, hey, how come your cash isn't matching your revenue recognition at this point? We're like, well, here's why, because accounting tells us to do this. We're sorry, state, that you guys are telling us to do this. And so now, not only are you trying to, explain to an auditor why you did something a certain way from an accounting standpoint, but not from a tax standpoint, it's kind of maybe your first roadblock a lot of times that you run into with harmonizing tax and general accounting.
Yeah, that's a great point, and I want to dive into some of that because I even have some questions on some gnarly scenarios related to bad debt and invoice basis versus the cash basis versus the rev rec basis, and then what do you do with tax? And I feel like there might be more than a few answers there.
Certainly, no, I think it's all interrelated, and even things like discounts, right? Is it a pure discount? Is it a manufactured reimbursed discount? So it can't just be it's a discount, right? It's who's paying for it, and how do we treat it? And I think the beauty in what I get to do is I get to say, oh, it depends because it's 50 states and 50 different rules, and it really is. I mean, that rule book is wide and vast, where you may think you've got it right in one state. Now you start expanding your transactions into multiple states, now you've got a completely different set of rules to play by, even in like border states and stuff like that too. So it gets sticky really quick.
Definitely. Let's hop to the next slide, and we'll dive into some of these common challenges and some other examples that we've seen. I think the big one that we run into is the fragmented data sources, and this is really when it comes to step one, unironically identifying those contracts. A lot of times those contracts are in different or disparate systems, and so these are ultimately like the operating systems. And again, these could be in order entry systems, CRMs. Sometimes they're just in file drives, and they're more enterprise, like low volume, high dollar transactions for the one-offs and some of those big customers. But ultimately, at the end of the day, that the first step in that rev rec process is about understanding your business model and where are those customer contracts getting emitted. Because to identify those contracts, you really got to get into the operating systems that those contracts and that operating source of truth lives. So that way, then you can curate the accounting source of truth. And that ends up being, again, decentralized in invoicing. Sometimes your point of sale ends up being from, Ed, to your point, both the cash and the revenue for the most part, other than for accruals like rate of returns, is going to line up a lot. For things that are more subscription type or over time, the cash basis is going to be completely different, and it's never going to agree because the contracts they identified, the performance obligation is in a totally different accounting period than the cash. But I'm curious, Ed, what you've seen in the past, and if is this the main problem that folks run into when it comes to initially implementing some of those rev rec steps?
The contracts are definitely the first area of complexity. It kind of depends. We can go through a couple scenarios. Let's say you're a growing business. You're most likely altering your contract to cater to your customers. And to Jason's point, they might be in 10 or 15 different locations with different wording, not lack of standardization. That creates a complexity in and of itself. Now you have to track all these different caveats, nuances, pricing, concessions, things like that. And you might have list on list on list for who you're doing the pricing, and you're trying to figure out what should I be recognizing, how much did I pay? Your billings sometimes don't reflect that. So in and of itself, the contract is usually the starting point and where things start to break down. Especially if you have lack of standardization, which a lot of us understand, the growing business. Sometimes you need to make concessions to make that big contract. On the other hand, right, maybe you do have very standardized contracts, but the nature in which you have to recognize that, Jason, it does get difficult, right? We're pulling data from different systems. Maybe your client deliverable, that point in which where you're providing, you're using your customer systems to upload data. If you're a software company, if you're a service company scanning papers, you're not working in a system that's yours, so tracking those inputs and outputs becomes very difficult. I really think that a lot of systems were not meant for good rev rec. And specifically, QuickBooks is meant to be easy, but it's not meant to be compliant. And then you got other tools like NetSuite that are very robust, almost too robust to the point where sometimes, they don't have the nuance. It's so hard to dig in to make it automated, right? It still becomes extremely manual because you can dive into such levels of detail where it's, not gathering the information you want, and it's not plugged in. It can plug into a lot of things, but maybe it's not recognizing it to the nature of your specific business, right? And that's driven by your contract. What am I delivering? When can I recognize it? And that can be, again, different from cash.
Yeah, and I think that's exactly right with NetSuite and what I've seen in the past, where if your business model is totally centralized in the ERP ERP. NetSuite can almost do anything. The challenge with NetSuite becomes if you have best in breed, how you collect payments from customers is potentially outside of NetSuite, or again, if you have contracts that are outside of NetSuite, then it becomes a challenge because now you have the ERP, which is kind of a source of truth, but accounting has to sit in the middle to translate from these decentralized operating systems into the ERP of NetSuite. And then that puts some undue stress and constraints on that team to really manage the data versus actually focusing on the accounting aspect.
9 times out of 10, to your point, it's being done in Excel and it's terrible. You've got this expensive ERP system, and then when we're coming to do the audit, it's this giant 40-tab Excel sheet that's pulling in all the data from the ERP, from the third-party systems. And truly, that's where the biggest issues come in. Audits aren't getting done timely. From your standpoint, at record keepers, it takes hours to close the books, right? And to get an accurate picture of where we're at, where we should be. And again, that's just due to volume. Even if you are just a retailer with a POS system, that's usually thousands of individual transactions. And you're trying to reconcile to the credit card reports with a 3-day lag. And if you're using multiple, if there's different credit cards and Stripe, it might be hitting the bank in every day has 4 different deposits, in which case you're still reconciling to multiple reports, hours upon hours in just reconciling your data to ensure you have the right numbers. And I think that's not always being done by an ERP. I don't know that NetSuite could actually do that, right? They're not going to know from the POS system exactly which credit card it is. So it becomes an extremely manual process to guarantee that you're being paid for the items you're recognizing.
Yeah, exactly. One question I thought of here when we talk about one of these challenge points that we hear from folks is the data changing over time. Let's assume, for the sake of argument, you have a subscription that started in January. It's a year contract, and then 6 months in, someone in customer service says, "Oh, we accidentally have this contract. The customer really didn't sign off on it," and they make it go away, right? Like they backdate in June to January, and they make it have never happened. What do you like to see in these like mutable scenarios? Like, what's the best practice for folks when it comes to that operational data change? Because if you reran the January report today, would give you a different answer. Accounting obviously has to account for that. What's the best way to do that?
Yeah, so in that scenario, you're looking at your close periods. It's a management decision, right? From an audit standpoint and a cutoff, you usually want that corrected in the period you can, right? But if you're going on hard month closes, a lot of times that's a call out of a mistake. You either go back and you re-update those statements. However, you're done making management decisions on January when you get to June. So if you were over recognizing something that shouldn't be there, you probably should be taking that hit in June when you find the mistake. But you kind of want to call that out. Hey, what did I really do versus what's my record keeping corrections? Because you always want to have an accurate picture of your business and what you're doing. But the truth is, GAAP would say if you find a mistake like that, you need to correct it. You over recognized in all these prior periods, you have to true it up at some point. Now, I would say, Jason, I see that a lot too, again, in this Excel nature, where they're literally, hey, I put it in the beginning, I ran it for the next 15 months across my tabs or across my columns, and oops. And now it's like, finding those little data points, going in and manually updating when there is a change, because there is a lot of times a contract change, a cancellation. Hey, they wanted to bundle. Actually, they're going to add 2 more contracts, so you agreed to give them a cheaper pricing. Finding, altering, adjusting. That's where it is essential to have a pathway and not a extremely manual pathway to get there, or just tracking your data becomes everything you're doing, right? You're not managing the business. You're just trying to keep up with the data to show that, hey, we're getting paid, right? We've recorded it, we're getting paid. You're not making educated decisions anymore. And that's what I think becomes a trap for a lot of these high volume transaction businesses. Is you got to pull yourself out of the weeds, but it's very difficult due to the nature of it.
I love the way you frame that at the beginning. You're no longer making management decisions in January. So as much as you could open that period up, at that point, now you're incongruent between financial accounting and management accounting. And that's a slippery slope, because at the end of the day, it's not just for external reporting, it's also for internal reporting and management. So I fully agree with you. The best case scenario for that is you show what actually happened in June, you show these prior period adjustments, and then you show the net, so you can tell the operational story as well as the catch up for the financial accounting. That feels kind of the good balance between both management and the financial compliance aspect.
Now, I'll tell you, if this was an audit cutoff in December, the auditor might have a different viewpoint of go push that back. But again, that's usually a top line thing just for all of our companies approaching audit. But yes, from a management, that's exactly what I think.
Yeah, fair enough. Intra-year, that's a good process. If it's a year,
Yes.
then we might have a different discussion. So that's a fair call out. Yeah. Well, let's pivot. I think we have another CPE question for folks. So let's head to the next slide. And yeah, we should have another pop up here for folks to participate. Perfect. So same thing as before, I'm going to read this aloud. What is your organization's greatest challenge in adhering to ASC 606? Is it number 1, fragmented data sources, 2, bridging the gap between theoretical and actual revenue, 3, changing contracts, or 4, varying types and schedules in revenue recognition?
In a good
And I
mix
like
right
this
now.
one is much more balanced with the answers.
Yeah, well, I think all of those, and that's speaking to the truth that they're all difficult, right? And I think if there wouldn't be that much or that big of a variety if there was really an easy solution, right? Now, the solutions are the key in this scenario, right? Another fun topic.
Another fun one. All right, perfect. So now we're pivoting to CECL and basically some of the expected credit loss, bad debt. And really, I think the frame up here, when we think about bad debt, it's both the actualization of what historical revenue was billed and unpaid for. And then it's really breaking those things down into different cohorts or like customer risk profiles and really understanding the percentage and basically the probability that one of those risk profiles, one of those customer cohorts is not going to pay. That ends up driving what becomes your estimate for future uncollectibles, which is really what CECL is about. What I really have always loved about this in the implementation, if done right, is historically what I saw before CECL when I looked at financial statements is you have your total revenue of $1 million. But as a fractional CFO, I knew when I was looking at some of these financials, I knew that 5-6% of that was going to be uncollectible. It just wasn't going to be uncollectible until our bad debt was written off for 2, 3, 4 months. This actually brings accounting more into the forecasting realm and says, well, hey, we know the probability that these customer cohorts aren't going to pay. So let's go ahead and build an estimate in the same month that we book the revenue. And so that way we have an operating expense that's reducing net income for this potential bad debt. So that really cleans up a lot of the timing between ASC 606 was great because made revenue right when the performance was happening, a lot better management, financial reporting benefits, and a lot better timing. Problem was a lot of this bad debt or uncollectible operating expenses were in different periods. Not great from the matching principle, not great from management to understand what was actually being written off. But that said, process-wise, this is again similar to 606 and arguably maybe even a little bit more challenging because you not only have the actual write-offs that you're booking every month, but because you're accruing for CECL, a lot of times folks will have a bad debt estimate and then the reversal of that accrual. So in any given month, you can have 3 transactions in your GL related to CECL for any given contract or customer in the sense that you have your actual bad debt, you have your reversal of your estimate from the prior month, and then you have your estimate for the current month. And that can be challenging to explain and even more challenging to implement, frankly. Now, Ed, I don't know if you agree with that. That's the best practice for implementation, but I'm curious as to what you see with your clients.
Yeah, and I think just a little background too for the group. So a lot of this has been because of the uncertainty in our economy, and that to Jason's point, most companies were just recording losses after they reached 90 days, 120 days, the write-off the bad debt reserve. So at that point, we're talking about sales that are a quarter to 2 quarters old, right? So it's really bringing the relevancy of the data to the forefront. And I think that a lot of that has come up with, again, COVID created a lot of challenges for business and write-offs. Balance sheets look strong until they weren't, right? So, the background on this is what the FASB is trying to do. The governing board is help businesses show their financials more accurately in the moment in which they're there. So the challenge, as Jason alluded, is really implementing that, and that involves estimates. And anytime there's estimates, it can get tricky. And so to Jason's point, yeah, the implementation of this, it has been difficult for a lot of companies in and of itself because you're estimating what you're going to lose, and usually it's a historical loss method. You'll look at how well did I do based on these risk profiles. Hey, government contracts, I don't care that they go over 90 days. And we used to historically just reserve, 50% of 90 days. Well, guess what? We know they're going to pay. They just take forever. You got to submit the forms correctly. They'll finally get you the cash. However, let's say you're operating in a business and it's a high risk business, right? Some tech startup in Bitcoin, right? For a while, the Bitcoin was gold, and then a lot of them evaporated overnight. So, you might say, hey, anybody I'm dealing with in Bitcoin, my historic losses say that that's about a 30% chance I'm going to lose money. You're taking an estimate based on the past as well as a forward-looking approach where you say, hey, has the economy changed for that benefit? So I think that coming up with those core line estimates, there's some thought process in there that historically, Jason, we haven't had to deal with. We just took a broad paint stroke to this bucket, that bucket. And that I think in and of itself has been the biggest thing. Now, to your point, the actual adoption is complex in that you have how much you reserve for, how much you reversed, how much you actually wrote off. That is a disclosure requirement that, again, for most small business owners and in financial reporting individuals, this is pretty technical and pretty heavy, and it's meant to cover a broad range all the way down to the small companies, unfortunately. So I really think this got overshadowed post ASC 606 and leases, but it is a complex adoption. So I think that we're seeing a lot of companies, hey, what does this really mean for us? And really, people are talking about CECL and they use those acronyms, and people don't even know what it is. But it's a big standard to adopt, and it is having some impact, primarily for companies that have trade AR. That is a guaranteed impact. It actually is a much more complex item if you have investments. But we're focusing for trade AR here because that's what typically we're going to see in these high volume transaction businesses. So from a credit card perspective, Jason, as we're talking, a lot of that is literally the returns, hey, somebody committed fraud on my credit card, those chargebacks. What are we getting? And now the good thing for most of you with chargebacks and credit cards is if you got a good tool and you can track that data, you really already know what your true write-offs are, and you don't have to go on historical. You're going to know every day or every 3 days how much of that real revenue am I collecting. Now, when you get into longer revenue streams like insurance contracts and things like that, that can be a lot more complex. So that was a little long-winded, Jason. I apologize.
No. I mean, that's why we're here, is to get into those nuances, because I think that's we agree it's a benefit to the timing, but it's adding more to the corporate accounting shoulders, and figuring out how to implement that and what the challenges are is definitely the goal to talk about here. I want to pivot because Jeff, we talked a little bit earlier about some of this, and this one's the one that always troubled me looking at financials and helping companies understand financial performance, was around, okay, we have revenue that we didn't collect. Do we owe the tax? Do we not owe the tax? And when you think about the bad debt, again, if tax is on a cash basis, then arguably you didn't get paid, so you don't owe it. Some tax obviously could be on a billing and or maybe an earned revenue basis, and there's obviously some nuances that I think you can share for folks.
Yeah, so from the sales tax side, I think the big thing is for the most part, as a general rule, is we're talking about as you invoice, you're billing the tax. That tax is being collected on behalf of the state, so you kind of have that duty, to give it to them, right? It's their money; it never was your money to begin with, and so that kind of triggers that initial requirement, right? So the second that invoice goes out, if you were to determine that, hey, yeah, it's an installment payment, we had to collect tax on the installments, and then they stop paying. Well, hey, we've already kind of collected that tax and then remitted to make sure that we're staying aligned there. So where the big piece comes in, and I guess where the other side of the coin of that is that a lot of sales tax returns and even some of your gross receipts type taxes and stuff like that do follow federal rules for bad debt deduction. So once you kind of have that bad debt deduction on the federal side, you are entitled to that bad debt credit on your sales tax return. Now, the biggest key is how the mechanism of that bad debt works, whether it's a direct credit on your return. Some states will actually trigger a refund claim where you actually, you still continue filing as you bill, and then you've got to go file a separate refund claim on that front, kind of documenting all your bad debts of what's been written off. I know the one issue that we always run into is, or the one question I always get is, hey, the second I file a refund claim, the state's going to come in and audit me, right? And that's a genuine concern. And honestly, some people get deterred from doing it because of that. But if you have that documentation backed up, that credit is there, and you're entitled to getting that money back because it is the ins and outs. You never got paid. You were never actually taking control of the tax that was due to the state. You were kind of essentially giving them that interest-free loan until you got paid in that situation. So there are those mechanisms there, and it really is understanding how the rules in each state play of how you claim that credit. I think the one question we get a lot of times too is, well, can't we just kind of flush it through our return and do it that way and just, not even claim it on the bad debt line? It's kind of that whole business decision of, can you do it? It's probably not the preferred method, but if it's something where the state can actually, where you can say, hey, this happened, this didn't happen, and credit ran through and they're getting their money, it could be relatively low risk if we're starting to talk about small dollars. Again, the risk comes as you start getting larger dollars in charge. You have a major default, or you have something where you're like, hey, man, we really didn't collect this tax. It really is kind of, and I'll probably sound like a broke record as I talk through some of the other stuff I will later in this presentation, is documentation's key. Showing what you did, what happened, and helping the state kind of understand, how the flow of the transaction went. Because I think the one probably not so secret anymore is that these state auditors aren't accountants. So the more you can help them understand, how the flow of transaction worked, how the bad debt was written off, how it was accounted, and why it shows up on your financial statements the way that it does, the more likely you're going to be able to kind of, pass that review with, limited inquiry from the state that way. But I think the key takeaway is as long as you're able to document those bad debts and show that they weren't paid, they were properly claimed on the federal under the federal rules, you're going to be entitled to that credit.
Got it. And this is more of my own edification. I'm just curious of this, but this is really a process where we might be making estimated sales tax payments that are based on revenue / invoicing basis, is not on a cash basis. But then when you're actually looking at what you owe, there's an aspect for bad debt for things that you thought you were going to get paid that you didn't, and that's really this extra apportionment for bad debt you're talking about for the returns that you really need to have broken out and explainable.
Yeah, absolutely. So let's say leases are really probably where, let's say you're in Ohio and you enter into a 5-year lease for a piece of equipment. So basically what Ohio will do is say, hey, we want all of our sales tax, right? So in that situation, you're gonna basically charge sales tax. So even though you're gonna charge that very first month's installment, you're actually gonna charge sales tax on the entire 5-year worth of the lease. Well, if they default on it or break it, that's where you've got to start working to determine, all right, how much of the tax didn't get paid? Can you even do it, right? There are some situations where they're almost like, hey, too bad, right? This is our rules of the state. You're kind of the one on the hook, and then your recourse is on your customer, right? To say, hey, what is this, a collection issue or what that piece is there? So a lot of times, that tax piece, is based on its invoice. So if you send out $1,000 invoice and there's $75 worth of tax on there, the way the state says is, all right, I don't care if you've collected that or not at the time of the invoice, you owe me $75. Yep. So now let's fast forward a year later, someone still hasn't paid that $1,075 that you invoiced them, and you're ready to start taking that credit on the sales tax return because it's been written off as bad debt. Now you've got to go through and piece it together and document it that way.
Yeah, and that's really an opportunity, like you mentioned, where if you have a couple percentage points of bad debt, call it 5% bad debt, and you're not doing this, well, there's a 7 to 10% of part of your bad debt you may be able to get back of taxes that you could have remitted, but you didn't actually owe to the state. There's really some found money there just from improving some of those bad debt and tax processes.
Oh, without a doubt. I mean, you're on the hook for it at first, right? And then it's to find out the source of that tax. And it's something that either A, people don't think about, or B, they don't want to go through the hassle of knocking on the state's door and say, give me my money, because they said, I've been through an audit before, I've been through one of these reviews. All they like to do is deny it, when they may not necessarily be wrong, but at the same time, it's valuable dollars that they can secure back with the right effort.
Jeff, in a typical
and again, we hit that. Go ahead, Ed. Sorry.
Jeff, in a typical POS system, are they going to submit that for you? Because I know a lot of times we talk, the credit card companies don't pay you for 3 or 4 days, but have they already paid the state in that scenario, and you were just out that cash, the chargeback?
Yeah, usually. So basically, it's gonna run through the POS system, and honestly, that's a lot of times of proving that you actually got the money refunded back, especially when you're talking about the credit card companies, right? I know we have some clients who literally get a report from their credit card company that lists out the bad debt, lists out everything that was charged off. And sometimes that'll work, right? Some states will say, "Yep, that looks good. That looks reasonable. You're a reputable credit card processor. We're going to take this as good." Other ones are going to say, "No, I need to see that this exact item was charged off and that you remitted this exact item on the front end," right? So they're going to make you jump through those hoops in that situation to show, "Yep, I remitted on this transaction, and oh, by the way, I wasn't paid on this transaction." It can get down to that level too.
Yeah, given the states are low on cash, I have a feeling they're definitely going to make it a little more difficult these days, right?
Yeah, which honestly is why a lot of people resort, for better or worse, and I'm not going to advocate either way on it, but why they resort to self-help, right? Where they're going to say, "I'm just going to wait for the audit, and I'm going to say, you know what, man, we collected $30,000 in tax this week, or I should say, charged $30,000 in tax this month. I think we've got about $1,000 worth of bad debt." And they basically matched it up in their system. Now they remit $29,000 worth of tax, and they're kind of documenting in the back end. Again, certainly not a preferred method. State's not going to do it, but if you can kind of prove it, it might not also be the worst thing in the world when you're talking about small dollars. Again, the big issues become it's big dollars. That's what we're was the state made whole. But the last thing you want to do is not remit money that the state's owed, right? That's the biggest thing, that they don't find the humor in you holding on to their money.
No.
Yeah, and if you don't remit it, you better have great records to prove that you never collected it, so you can defend yourself. And that ultimately is, well, even if you don't follow the best practice, you need to be able to prove what happened at a point in time.
Absolutely.
It's probably as difficult if you don't have good data, right? And so we're coming back to that data.
Yeah.
Great. Well, let's pivot. We have another CPE activity question, so let's go to the next slide and have the pop up.
And it's worth noting that this was essentially effective for 1/1/23. So most companies, if they haven't been implementing it, a lot of what we found is that if you actually did, a lot of CFOs and financial reporting individuals, they are looking at the risk, right? You are reserving for those specific accounts. Saying, I'm getting a little scared on that. We have found that doing this analysis under CECL tends to come in very close for most companies, unless you were the total, hey, 90 days is 50%, 120 days is 70%. If you just put the blanket approach, there probably was differences. However, companies that were taking a more thorough approach of customers, it has not been a big adjustment, we'll say. It's just a new method and thought process when looking at it.
Which really means they were already taking into consideration the portfolio risk characteristics, and so that they already had some of the practice out there.
Correct. Just put the defined steps together in the codification, essentially.
All right, great. So pivoting to our next topic, we'll talk about tools and software solutions. And I think a good way to frame this is we have got operating and accounting systems. Operating systems become, your order entry, how you bill and invoice and collect. Ultimately, a lot of where your operational folks are working day to day to kind of serve your customers and where the work is actually being performed. And then you have some of the accounting systems, which is how do we best account for what happened on the operational side to make sure that we're compliant, we understand what's working and what's not from a financials perspective. And so there's a couple things, themes we talked about. One is centralized versus decentralized. At the end of the day, there are business models, like you mentioned earlier, where NetSuite, like you have an ERP and your entire subscription or order to cash process is done in the ERP. And those are usually great use cases for the ERP because you have a centralized source of truth. They can handle high volume. You can reduce your reliance on spreadsheets, and you can also have the right multiple bases where you can have a tax basis, you can have a GAAP basis, you can have a cash basis. And some of those tools like NetSuite support that. It's really the thing for high volume businesses, though, that it tends to be more decentralized because they have customers that are coming from multiple revenue streams, sales channels. the customers pay in different ways. And so you have things like, Recurly and Stripe and a lot of these third-party payment systems. A lot of folks have internally built order management systems. And that's where some of this ERP is really less of an ERP and it's more of a general ledger. And that's that decentralized model. So I think it's helpful to kind of categorize, a business model into one of those two parts, which is really a matter of then identifying where your challenges are in terms of the tools and solutions you need. And so obviously a decentralized business and a centralized business are going to have very different needs. The decentralized business models, a lot of those folks are the folks that are, have that 20 tab spreadsheet that you mentioned, Ed, and they've got, a rev rec spreadsheet, they've got a tax spreadsheet, they've got a bad debt spreadsheet, all of with a bunch of tabs. And that's really where I think you can start to break that down into those different specific problem areas. And those problem areas end up aligning to what solutions you really need to solve rev rec or like expenses and expense allocations, payroll, budget, taxes. Like that's how you get into those best practices. And Ed, I know you and I talk about this a lot, but I think we've joked that 50% of solving the problem is just identifying and putting requirements around the problem. And that's a lot of what I think this is for success for folks, because even the best ERP and the wrong implementation is going to put a lot of strain on folks and actually not help their organization or their accounting team.
Yeah, it should be, in my mind, the software should either be limiting the number of resources you need to close, or reducing close time, like getting you better financial data. If it takes you a month and a half to close, you're already 45 days behind the eight ball from a data perspective. So, I mean, that's not running a business. You're just recording what happened.
Yeah, and then where's the opportunity loss in really understanding what you could have done differently from a management decision perspective? And that's, I think, where a lot of the corporate accounting folks are kind of caught more in that compliance. We're going to get the month end close done. It's 45 days in arrear, but they actually have the most valuable information in the organization, which is getting those financials for management decision in more real time. That's where a ton of value is on the table. Like, is this product working? Did this marketing program or this discount work? If they're waiting 45 days to get that information, while you might be compliant, there's probably a lot of strategic value that you left on the table there for the CEO and the execs that run the company.
Well, and truthfully, the number of financial professionals is reducing rapidly. If you need that many hands and spreadsheets, it'll be tough for your business long term. I mean, I see clients struggling to replace everything from CFOs down to AR clerks. I mean, it's a difficult animal out there. And I think that the more decentralized, the more you live in spreadsheets, the harder it is. People get sick, you lose somebody, and just getting back on the horse gets tough. Then you start remitting your sales tax, and then you got to call Jeff because things have really gone haywire. And it's a slippery slope, I think, from a data perspective. So it's just
well, and that's where no one wants to be sitting in the situation where their business is growing, and they have to grow their accounting team proportionally to the business overall because they have to manually process all the transactions. Like that's a hard argument to make to your team, yourself, or anybody. When you can potentially invest in automation and then keep yourself and your team more strategic for accounting, you don't have to grow proportionally, but then you start to get that data real time. That's the difference between staying in that kind of bookkeeper mindset, without some of the tooling, even though you're capable of being strategic, to saying, no, I actually have a seat at the table to help the management decisions because I was able to automate these processes. And that's a very different role and a different type of value that you're adding to an organization to get there.
Yeah, and I think that that's also the pricing, right? People struggle, they see the dollar figure, but the reality is you're probably saving 2 or 3 hires if you go from decentralized to centralized with automation, right? Now I'm looking at, hey, I would have had to hire 5 people to keep up with the growth, but I'm like prepared for it. But it is, I know that's a big ticket, and a lot of people get scared when they get to that point.
Yeah, exactly. Well, Jeff, I know one of the bullets we put out here is never wait till the end to consider tax. I've personally been burnt by this and done the ERP implementations and then thought about tax like during the when looking at the schedule of the implementation, and I'm like, yeah, we waited too long to consider some of this. But so I'd love to hear your take on how to think about not only planning for tax use cases for some of the tools and software, also some of the best in breed sales tax type of softwares that you've seen out there for folks.
Yeah, absolutely. No, nothing like the irony of making that the last bullet point there too. Um,
I'm guilty of that.
but no, it's interesting because like as I was kind of looking through some of this stuff and think about what I was going to say. I think you guys hit on a lot of the things already, right? Of being strategic and doing stuff of not necessarily being a storyteller and taking 45 days to do something, but what if we automated something to get sales tax done? Instead of scrambling on the 19th of every month or the 20th of every month when the returns are due, what if we had these things done 4 days after close because we were able to automate it, right? And so then you start looking into the first question really has to be is, what are your needs, right? What are your needs and what do you want? Because the second that you go, and there's a lot of software companies out there right now. We'll talk about a little bit of some of them. There's some that are Cadillac that will do everything for you, from automating determinations, from use tax calculations to doing everything and basically having returns ready for you to review and press send on, all the way down through to somebody who just bolts on a rate tool to your ERP, and then you kind of manually do a process, right? And so there's going to be that range of price as well too, and range of sophistication of what you sell. So before you go into this whole process, I think the one thing you really got to understand is what do you want to get out of this, and then kind of work it from there. Even to the point of what is our ERP, what are we using, and are the tools that we're evaluating, what's the lift look like to get it integrated, right? So if you have an ERP system that's not a NetSuite, that's not one of the ones that you've heard of before, it's a homegrown one, it's going to be a lot harder to integrate a tax engine into it, because a lot of times some of these tax engines like an Avalara you've probably heard of, or a Vertex or something like that, they're working with these ERP vendors to say, how can we make our tool work with your tool better? So now you're working with a homegrown one, and they're like, man, I've never heard of Max 2000i or something like that. What is that? Like, oh, we made that 20 years ago. That's why it's called 2000. So it's like, okay, you've got to do a little bit of lifting and work that way. So I think the biggest thing is understanding what you have and what you're working with before you make that determination of here's the product I want to go with. And also knowing that, before you reach out to a software vendor, knowing what their products they sell, and also knowing your own product and doing a little bit of homework as well too, so that, someone's not coming in there and just selling you on a bunch of stuff saying you need this, you need this, you need this, when all you really need is maybe one of those initial modules to properly calculate the tax or properly do something like that. Doing pre-work to understand, where am I filing right now? Where should I be filing right now? And is there a software partner that can help me do that? Or is there something else that I need to do independently to kind of come and say, no software vendor, here's what I need, and help me work that way? Because and again, I don't want to typecast a lot of software vendors, but their job is going to get you to file in as many states, use as many of their products at once when maybe you don't need something. So some of the software vendors, we can kind of run through them a little bit of the more popular ones, and kind of what they do, right? So I'm sure the one that a lot of folks have heard of already is a company called Avalara. They're a great marketing company, really good at making things simplified and bolting onto a lot of ERPs as it is already, right? So they can pretty much plug and play and do stuff pretty quickly. But where that price point comes from is that the way that their pricing model worked is that it's all transaction based. So if you're a higher volume transaction and you have a lot of transactions, you're going to be buying a package of transactions, and you might be paying more for it, versus if you go to somebody who's on a more flat rate, or if you're on like a Shopify system where you're saying, hey, we're just going to buy our monthly system, you're going to be doing a little bit more of your work on your own, to start doing a lot of the internal mapping and a lot of the internal detail. So that pricing might be a little bit less on a platform, say like Shopify or something like that. But you might have to kind of pull some more manual reports that way. Even to, so like I mentioned, kind of like a Vertex, right? So Vertex is kind of one of the ones that is kind of an all-in situation where they've done, thousands of mapping codes to say, every little widget that you sell, we're going to get exactly correct in every single jurisdiction in the country, right? So that if you ship something to East Baton Rouge, Louisiana, you're going to get the right tax treatment and you're going to get the right rate, So it's like, okay, but that comes at a price too. So it really is kind of understanding your needs, what you sell, what you want, and honestly too, where you're at in your business cycle too. If you're at a point where maybe you're looking to sell or do an exit, it might not make sense for you to lay out all of this money to just kind of sell your company in a couple of years. Now, if you're planning to hold on to it and you know you're going to be collecting a lot of tax, maybe that's something that you want to do, right? So there's a lot of things that kind of are in play when you're determining what sales tax software do we want to use, all the while basically saying, the biggest thing is how are we making our lives easier and making people kind of more strategic in thinking about getting that right tax collection.
Totally. And it goes back to that first principle of working backwards from those requirements, like you mentioned, and then you won't run the risk of the software shiny object. Oh, this is so cool, when really there's a couple key use cases that you actually need. And what's the most efficient way to get that done at the point in time for your business? I think that's perfect advice.
Yeah, you still want tax walking the dog in this situation. Like that's the big thing.
Perfect. So let's pivot. We have another CPE, and then we have a couple minutes left, and we're going to go through the rest of our content. All right. So which problem area are you hoping to find a tool to manage? Is it revenue, expenses, payroll, budget, or taxes?
Yeah, that payroll. Yeah, payroll is all that outsourcing. So I think, to your point, Jeff, I always worry about the taxes, right? Because that is tough to keep up with. But revenue is right up there with complexity too. Budgeting, that's an interesting one. I see that though. It's tough to use the data these days correctly. Jason, I mean, you see that all the time, I'm sure.
Yeah, no, I share your take on that. With most of the time, getting clean actuals that you can cohort and segment the way you want. That a lot of times becomes the hard part of budgeting, and then budgets themselves, unless you're going crazy with a rolling 3-week that you actualize constantly. Not as much value in really understanding your business and executing it as budgeting for it. So our last deep dive, data management practices. So I think we framed this one a little different, and we're really starting with a question. And really it's, I think, to Jeff and Ed, from an audit, you always got to be able to have the detailed backup, and you got to be able to recreate the story that your GL tells. But would love to hear from you guys, like what makes up the best practice and what a great audit looks like from a data management perspective, and then what's the not so good look like.
I mean, from like we're talking revenue, I'll let Jeff cover the tax side of that. I mean, we're looking for matching, right? If you say the system's linked this way and we do some samples, it better be, right? If it's not, like, you should be testing that too. If you're trusting a third-party software vendor, you better be checking it. And, especially when you're dealing with other people's money and all these other issues and risk, it's your responsibility to select a good vendor. So if they tell you you're doing it, you got to find a way, hey, how can I prove this out? Even for your own comfort. This is coming up a lot too when you think about cyber. Not that we're stay on topic, but like when your data's outside, like you got to know how it is, how you're exposed, and this is just risk management. So I think when we talk from how do we know they back up from the GL, that should be your question too. Hey, I know it's linked. How can I tell? How can I do some verification? You should be doing some sort of data check occasionally. Because ultimately, a gap here, it's kind of like that movie Office Space, right? You think these pennies are rounding out, and all of a sudden you're missing millions of dollars because you were trusting the automation without any verification. And so I think that's where I see a lot of these issues. Automation's fantastic. You just have to own it.
And honestly, Ed, I don't think we're that far off on even though we're two different worlds from that standpoint. It's documenting things is key, right? So if you said you did something or you did it, if you have A and C, but you don't have B, it gets really hard to believe that A actually happened because you don't have the trail that got you to that point, right? And I think that's, if you can test and show, yep, this ties out, great. When you're doing something in real time, it's easy to say, oh yeah, here's what I did, but now come ask me what I did 3 months ago and why I did something the way I did without documenting it, and you're just not going to remember. Now do that 3 years later when a tax audit comes in and your work papers are there, your accounting system isn't matching your sales tax returns or whatever return it is, and you've just run into an issue where it just kind of snowballs. So I think from that standpoint, we always just say have an audit ready file whenever you can. Just so that it becomes easier to explain something. And it gives you more credibility when you are getting audited to say, hey, here's all the stuff that ties out. So when you talk about something else at a different point of the auditor is more likely to believe what you said because everything else that you've done has kind of tied out and proven. And you're kind of getting the benefit of in those situations.
Yep, that's exactly how trust is going to be built for auditors or anyone, frankly. But yeah, I mean, part of the principles that we used to build Hubifi when it came to kind of validating the data and building that trust was totally around that lineage and provenance. And I mean, Ed, you and I talked about this in the early days, especially with a couple of our first customers, and it was really, here's the overall, caption total of my financials. Here's the account balance at a point in time, and really get into that trial balance and the transactions that make that up, and then lineage to walk that all the way back to like how you got to a number. And then the provenance is really that like source system, the external ID you base the accounting on. So if you can go from the top level financials and walk it all the way down, or if you can take an operating system ID and then randomly select that and see all the accounting that you did, if you can do those things for your financials, then you're going to have a great audit. You're going to have an efficient audit, and you're probably going to have an affordable audit. And I think those are the principles that folks like have to apply to have great data management for the purposes of ever-changing operational data meets never-changing financials. Not an easy task, but you have to think about lineage and provenance to get there.
Yeah, I think you already mentioned it earlier, Jeff, too, with being sold down the river on some of those softwares, and it's sad. A lot of times people they think they're buying the solution to all their problems, but you still have to understand that, as you're saying, Jason, and own that as you go through that process. It isn't just the, hey, I'm no longer responsible.
You're still going to need that
Even with SOC 1.
Yeah, absolutely.
Perfect. Well, I think we have one more CPE, and then we're going to wrap. So we'll get the last pop up going for folks. This one's a hard one.
And for all our listeners, I mean, feel free to reach out to any of us. I know if you're having sales tax software questions, things like that. The nice thing is, unvested interest, and a lot of times it's really just a conversation, and I think that a lot of companies are going through and trying to figure out what they need, and we're happy to be a resource in part of that conversation for you.
Definitely. And a reminder for folks too, if you have questions, feel free to submit them in the chat. We're happy to answer questions, whether it's now or later. We also, I think, Kyrie, I think you'll have to jump in, but I believe there's an evaluation survey that folks need to take for purposes of the CPE requirements as well.
Yes, you can just leave yours on.
Oh, Kyrie, I think you're on mute.
Anyway, I think they're both on mute. I can cover. Ultimately, for CP credit, please, use the QR code here and complete the survey. Also, we have upcoming events. If you're looking for more webinars and more training, feel free to register. Those CPs will be processed, if I'm correct, within the next week or so. So if you have any questions or problems, just reach out to us and we can help you with those.
Perfect.
Oh, there you are.
And can we drop, is there a contact email we can drop in the chat for folks to be able to follow up with questions or anything they're looking for after the event?
Still muted, Kyria. There you go.
Sorry, I lost you guys for a minute. I don't know what happened there, so I apologize. But yeah, I feel like Ed was talking. I saw his lips moving. So if you guys have any questions, feel free to reach out to us. Thank you so much for taking the time out of your day to listen to our presentation, and have a great rest of your day.
Thanks all.